When a business spends money, it seems pretty straightforward, right? You pay for something, you get something. But in the world of accounting, it's not that simple. Not all spending is created equal. How a company decides to label a cost can totally change its financial story, and we're going to break down exactly how that works. Okay, let's make this real. Imagine you have a delivery van for your business. You fill it up with gas to make your deliveries. A few months later, you have to replace the entire engine. Now, both of those things cost money, for sure, but an accountant looks at them in two completely different ways. So what's the deal? That's the exact question we're going to dig into today. So first up, we've got something called a revenue expenditure. The easiest way to think about this is it's the day-to-day stuff, the costs that keep the lights on and the business running right now. These are things that get used up fast, usually within a single year. That gas for our van, it's the perfect example. You burn it, it's gone, and you got to buy more. And on the flip side, we have capital expenditures. Now, this isn't about the daily grind. This is about the future. This is a big, chunky investment in something that's going to last, like buying a new piece of equipment or making a major upgrade to an old one. That brand new engine for our van, it's not going to be gone next week. Nope. It's an investment that's going to be paying off for years to come. Okay, so how in the world do accountants draw the line between these two? Well, thankfully, there's a pretty neat framework they use, basically a set of 5 key questions. Let's walk through them, and I promise you'll be able to spot the difference every single time. First up is the time test. This one's probably the most intuitive, the easiest one to grasp. You just ask a simple question. How long is the benefit from this spending going to last? And right there, that's your dividing line. If the benefit is all used up within this financial year, like paying your monthly electricity bill, it's a revenue expense. But if that benefit stretches out for more than a year, like a massive renovation on your office building, then bam, it becomes a capital investment. It's all about short-term versus long-term. All right, next question. We got to look at the asset's life itself. Are we just doing some routine maintenance to keep it running, or are we actually doing something to make it last longer than it was supposed to? This really gets to the core of maintenance versus improvement. Putting gas in the van, that just maintains its ability to drive around today. That's a revenue expense. But swapping out the whole motor for a new one, well, that extends the van's useful life for years. That's what makes it a capital expense. See the difference? Okay, our third question is all about performance. Are we just keeping things humming along as they are, or are we actually boosting the asset's power, its output, or its efficiency? Let's say you've got a machine in a factory. Just putting some oil on it to keep the gears turning smoothly, well, that's just maintenance. That's a revenue expense. But what if you install some seriously upgraded parts that let it make more stuff every hour? Now you've increased its capacity. And that, my friends, is a capital expenditure. Question number 4 is all about the money. We're asking, how big of a deal is this expense in the grand scheme of things? Is it a drop in the bucket, or is it a major outlay? It really just comes down to relativity. A tank of gas costs, what, a tiny fraction of what the whole delivery van is worth? So yeah, that's a revenue expense. But a brand new engine, that's a really significant chunk of the van's total value, which is why it's a capital expense. I will say, though, this one can be a little subjective. What's significant for a huge corporation might be different for a small startup. And that brings us to our final question. This one is about rhythm and routine. Is this a cost that just keeps coming up over and over again? Or is this a rare, maybe even a once-in-a-lifetime event? So costs that happen on a regular schedule, like your monthly rent or your weekly payroll, those are classic revenue expenditures. But a massive project that happens, maybe once in a decade, like adding a whole new floor to your office building, that is a textbook capital expenditure. It's not something you do every year. All right, so now we know how to tell them apart. But so what? Where the real rubber meets the road is in how these two different types of spending actually get recorded in the company's books. And listen up, because this is the key to the whole thing. A revenue expense, like a 500 dinar phone bill, goes straight onto the income statement. It immediately makes the company's profit for that month look smaller. But a capital expense, like that 2,000 dinar engine, it doesn't hit your profit. Instead, it goes on the balance sheet and actually increases the value of the company's assets. It's treated like an investment, not a cost. Now, when we're talking about that big capital investment, it's never just about the sticker price. To do it right, you have to capitalize, that's the accountant term, all the costs that were necessary to get that asset in the door and ready to go. Let's look at a quick example. Say a company imports a machine and the purchase price is $15,000. Great.
But wait, you also had to pay customs duties, right? And shipping fees. And you had to pay an expert to come in and install it correctly. All of those things were absolutely essential to get that machine up and running.
So when you add it all up, the real cost of that asset, the number that's actually going to go on the balance sheet, it isn't 15,000. It's 23,000. That's its true official capitalized cost. So, we've gone through the definitions, we've gone through the 5 tests, we've even looked at the bookkeeping. But why should you care about any of this? Well, this one little distinction has a massive, massive impact on how we see a company's financial health. Okay, here's the bottom line. Revenue, expenses, they drag down the profit a company reports this year. Capital expenses don't. They get shown off as an investment in the future. This one little decision affects everything: the profit numbers they report, how much tax they have to pay, and what an investor sees when they look at the books. Honestly, if you want to understand how a business really takes, you have got to understand this difference. And I'll leave you with a little something to chew on. What about replacing all 4 tires on that delivery van? I mean, it can be a pretty big cost, and you don't do it every month, which kind of feels like a capital expense. But the tires themselves, they're probably only going to last about a year, which feels like a revenue expense. See? Sometimes the tests conflict, and that's where good accountants have to use their judgment. So, what do you think? Where would you draw the line?